In this session, I'm going to look at the key concepts that are included as a part of the portfolio construction process. So, to start with, I would like to look at the typical inputs that go into the portfolio construction process. Right? To start with the key inputs going into the portfolio construction process. So, whenever we are going for a new portfolio, I would first have a look at the current portfolio, first thing, and probably one of the easier things to know because I can understand the weights and the current composition. All this is very easy to understand. So, more or less, there is a very little uncertainty with identifying the current portfolio. So, it is more or less determined with a large amount of certainty. But along with that, to construct a new portfolio, I also require the various alphas. Alpha is a measure of excess return over the benchmark. It could be the risk-free rate of return or any other benchmark return that has been set. And this is again an uncertain quantity. So there is a possibility of error in the assessment of alphas because the alphas keep changing with time, and depending on the frequency and the time period of the data that I have considered, the alphas may change considerably. So that's one of the reasons the estimation of alpha is always prone to some kind of error. Along with that, because I'm more focused towards the portfolio, I'm more interested in the covariance and the correlations that are currently present between the various asset classes and the estimates of the covariances and the correlations for a future date. So obviously when there are estimates, there is some level of uncertainty in the process. So even understanding those aspects are some of the good inputs for building an effective portfolio. And along with that, I should also look out for transaction costs, especially if I'm involved in very active portfolio management mechanism. I will be keeping on selling some of the securities, buying some of the securities. So there is a lot of transactions that are involved, which means the transaction cost is also heavily involved in it. So how many transactions will happen? What would be the cost involved? And if possible, amortizing, even if I am more or less passive. So whatever the huge cost that is incurred is at the beginning itself. So how well I estimate and amortize the cost over the life of the investment is one more important thing, because our intention is to decide an optimal portfolio taking into consideration all these constraints that can play a very important role in the optimal portfolio construction process. Apart from that, I also talk about the active risk aversion level. Means if I am going for active portfolio management kind of a mechanism, I have to decide what is my active risk level, which means probably otherwise people call it as a tracking error. So I need to have an estimate of the tracking error, and which is typically that excess returns, what is the standard deviation of the excess returns, how consistent are the alphas. So that is one more dimension that needs to be analyzed as a part of the portfolio construction process. Now, out of all these things, it is very clearly evident that only the current portfolio is more or less a certain kind of a value, whereas all other things are more and more uncertain. So, to what extent we are successful in estimating those numbers will define the effectiveness of our portfolio construction process, right? Now, okay, now a very important aspect dealing with alphas. We have already talked about that alpha is nothing but it's a measure of excess return. And what we are saying now is whatever the alphas that we are computing, we actually get into a process called refining alphas. We don't take the alpha as it is. We get into the refining of the alpha because we take into consideration the various constraints that are imposed both by the investors as well as by the managers in the portfolio process. Because from the investor's perspective, there could be some level of constraints like short selling is not permitted on some of them. So the alpha, when there is no short selling, obviously the alphas which are negative, probably I may not take any kind of an advantage out of them. So some kind of a refining of those alphas have to happen to take into consideration all the investor related constraints, or probably there could be some kind of constraint from investors perspective on the amount of cash that could be held and amount that needs to be invested as a part of the at any point in time, what should be the proportion of the cash in the portfolio. And at the same time, from a manager's dimension, yeah, probably there could be some kind of restrictions on the sectors. In a particular sector, the investment cannot be more than this much percentage, or probably there could be some more constraint with respect to diversifying across high risk taking and low risk taking kind of sectors. So because of all these things, the alphas in the original dimension, they get refined, and on the modified alphas we apply the portfolio optimization mechanism, probably using tools like Excel solver or Tora or any of the linear programming kind of tools can very well be used. We do a portfolio optimization to achieve an optimal portfolio approach. So either I refine the alphas and use an appropriate portfolio optimization model, or I directly go ahead doing an unadjusted kind of a mechanism. Both of them will rely or will result in the same kind of an outcome itself. So that is where we talk about the alpha. When we are doing a refinement to the alpha, we are using two mechanisms. One is called scaling and the other one is called as trimming. As a part of the scaling, what we do is we compute the alpha by multiplying this with a factor that lies between 0 and 1. That is what we call as a score, which is like, I mean, it's not 0 and 1, which a mean of 0, it's like a normalized value. We talk about a mean of 0 and the standard deviation which is determined by a standard deviation of 1. So which means the volatility, when I am talking about alpha from here, the scaled alpha, when I look at it from this dimension, whatever is the original volatility that is there, I multiply it with the information coefficient and I multiply it with the score. The score will lie between 0 and 1, which means alpha will lie between 0 because the score could lie between 0 and 1. The mean value for the alpha will be 0 and it would be volatile with based on the volatility times the information coefficient. So when I am talking about information coefficient, this is beautifully described as the correlation between the actual and the forecasted. So if the actual and the forecasted are more or less the same, then probably the volatility will be based on volatility multiplied by the information coefficient multiplied by the score value. So this is what is going as a part of the scaling process, and whatever the alpha that came by the scale value, it would be compared with the absolute values of the alpha. Now, if the absolute value is at least more than 3 times that of the scale, we will either try to reduce our weightage on in those particular securities. We'll try to remove those because there is some kind of abnormality with that data. So probably from an investor's dimension, we would try to pull out the investments from those kind of, we would try to reduce or remove the positions from those kind of securities, or we try to bring that absolute value of alpha to within 3 times that of the scale value. So this is something which we do as a part of scaling and trimming, which is a process of alpha refinement. All right. Now, the next important topic that needs to be looked at on these lines is the concept of neutralization, removing biases from alpha, or probably undesirable bets, speculative kind of undesirable kind of bets from alphas removing is what we call as a neutralization process. Generally, there are various mechanisms that are available to do the neutralization. One commonly available mechanism is the benchmark neutralization, or I could look at cash based neutralization, and three, I could look at risk factor based neutralization. So making neutrality, making the portfolio neutral on these dimensions. So when I say benchmark neutralization, for the benchmark, whatever we have chosen, I would make sure that the alpha is 0 for that benchmark. So even if it is not 0, I will like to do the adjustments in such a way, I'll try to give the positioning in such a way that the alpha of the benchmark is going to be 0. And similarly, when I say cash neutralization, I would try to avoid the active cash management process. So active cash management does not exist in this. Similarly, when I talk about risk factor neutralization, with that particular risk, so whatever the return associated with a particular risk factor, that is made equal to 0. So no value addition by taking a specific risk. That is what we call as risk factor based neutralization. The intention, whatever is the mechanism of neutralization, it should be specified. It should be specified at the beginning of the process itself. So whatever, when I say, let's say like when I say a benchmark based neutralization, it is as good as saying the alpha of that is 0, which means the beta of that position is more or less equal to 1. So even if the benchmark's beta initially is not 1, it is modified in such a way that the beta of it will become 1 itself. So if the alpha of it becomes 0, the beta will come closer to 1. Similarly, when I am talking about cash neutral, as we said, we are adjusting the alpha so that the cash position is nowhere active. So it is very much possible that any portfolio, I can try making it both benchmark neutral as well as cash neutral. So these are some of the things that we need to understand as far as neutralization as a process is concerned. Now, the next task that we need to look out, the next dimension that we need to look out is the concept of the transaction costs. First thing, it may be appearing that there is not too much, I mean these costs are typically negligible when we are looking at a bigger picture, But what is generally understood is the more and more the active trading that is happening, the transaction costs are typically going on a higher side itself. So it also is like, even if some kind of arbitrage opportunities come up, we will not exploit these arbitrage opportunities because of the presence of transaction cost itself. So the what could very well come out as a conclusion is, even though a new portfolio is looking more optimal based on our model, even though a new portfolio is looking more optimal than the old one, the higher transaction costs will prevent us from shifting from the existing portfolio model to the new one. So, making an adjustment into the alpha itself by including the transaction cost will make the estimates of alpha more and more robust. If our alpha estimates include even the transaction cost, the overall the estimate of the alpha becomes more and more robust. So on one side there is a huge benefit including the transaction cost, but at the same time what we could also notice is, if I am trying to include the transaction cost, it complicates the process, because though let's say I am including one important transaction cost, the cost is incurred at what point in time, but the benefits are there across the period. The returns are see, I have purchased, but the returns are coming over a period of time, but the cost is incurred only at one single point in time. So there could be a lot of timing related differences associated with the transaction cost. So we have to make sure that when we are including the transaction cost as a part of alphas, enough care has to be taken so that these kind of complexities are handled in a much better manner, right? Then when we are trying to construct a portfolio, there are so many practical issues that may come up. Okay, now understanding all these things, let's say we started creating or constructing a portfolio. There could be various practical issues that may come up. For example, we are talking about what is the level of risk aversion? What should be the level of risk aversion? Or what should be the optimal risk? How do I compute what is optimal risk? Or what should be the alpha coverage? All these things will become a big challenge from a practical dimension, because whatever are the inputs that have to be taken to understand the risk aversion level, those inputs need to be as much accurate as possible. So to each of the risk, what is the aversion levels? What are the different types of risk? And to each risk, what is the aversion level? That will go as an important aspect in terms of addressing a position specific risks across various portfolios. Similarly, when I talk about from an alpha standpoint, see, especially what could very well happen is, the portfolio manager is trying to look at the stocks which are not in the benchmark, and obviously the forecasts associated with them are not present in the benchmark. So how well the portfolio manager is trying to address all these things will go as important aspects as a part of the portfolio construction process. So generally when it comes to risk aversion, we see that it is measured. There is a formula which has been discussed with respect to risk aversion, where we talk of it as the information ratio, which is a kind of a measure with respect to the deviation from the actual and the benchmark. So using the tracking error and the actual return, we are computing the information ratio divided by twice that of the active risk. So this is what is a measure of risk aversion. So when I am talking about this will be a kind of a tracking error. So information ratio divided by twice the tracking error is what we are able to call as the risk aversion level, and this risk aversion will go as an input into the mean variance framework, which is helpful to determine the utility. Utility is always coming out as excess return minus the risk aversion multiplied by the variance. So this is talking about the utility level of the customer. So the aversion to general factors as well as the specific factors need to be understood. So when I am talking about specific factors, it helps the manager to typically understand the position which is having a huge losses and diversify accordingly. And at the same time, when I talked about a proper alpha coverage, we are talking about weighted average of alphas with the forecast, and we are dividing it by the value weighted fraction of stocks with the forecast, where the value weighted fraction of stocks come as sum of active holdings with the forecast. Whatever is the proportion of the holding with the forecast, so that is what will give me the average alpha for the stocks, and this will help us in addressing the proper alpha coverage for a typical position. And then the next aspect which we have to constantly look out for is portfolio revision and rebalancing. The portfolio revision as well as portfolio rebalancing. So here I am more looking out for alpha. Should I decrease the alpha? Should I increase the alpha? What should be my target alpha? So there is some kind of understanding that is happening in the dimension of alpha, in the dimension of risk. From transaction cost perspective, I'm looking at all of them and even the time horizon. So there is some kind of trade-off on all these dimensions, which is playing a role as a part of the portfolio rebalancing process. So it again depends heavily on the portfolio manager whether he wants to be conservative or aggressive. Based on the various uncertainties that are associated with each of the inputs, the portfolio manager can either choose to be more and more conservative and more and more aggressive even. Because on one side, if we see the time horizon, the shorter it is, the alpha will be more and more uncertain, but in the longer term probably alpha can come very closer to zero, but in the shorter time horizon the alpha could be very significantly positive or significantly negative. So depending on the strategy which the portfolio manager is typically performing, the rebalancing mechanism should take into consideration the time horizon, because based on that the alpha certainty and uncertainty will look at, and even based on the number of transactions that are being planned out, the transaction costs also would either be going up or going down. So it's a kind of a trade-off on multiple dimensions that are expected for a portfolio manager. So enough care has to be taken in terms of the portfolio understanding the portfolio diversification kind of a process, because whenever we are doing a revision or a rebalancing to this portfolio, all these points need to be considered, because on one side I can talk about the overall value addition. When I say value addition to a portfolio, whatever is the contribution, the marginal contribution, all I could look at is the alpha, whatever is the excess return which is a particular asset is generating, minus twice the risk aversion that is coming out from your information ratio by 2 into active risk. So 2 into risk aversion into active risk is nothing but information ratio. 2 into risk aversion multiplied by active risk is nothing but information ratio multiplied by marginal contribution to the active risk. So when we are talking about marginal contribution to value addition, I take it as alpha minus information ratio times marginal contribution to the active risk. So this is what is the additional contribution to the value addition. So typically when I am talking about a no trade range, if at all I am looking at the cost of selling is less than the marginal contribution to the, if the marginal contribution to this value addition is lying between the cost of selling and cost of purchase. This is what we call as the no trade range. So this is one more way we can understand the portfolio and at what point we actually get into the rebalancing and at what stage we get into the revising and rebalancing of the portfolio. So, but at the same time, if I am considering transaction costs, right, if there are too many transaction costs, at some point it may so happen that even if new information has come and that is proving that the new portfolio is more optimal compared to the existing portfolio, the higher the transaction costs are, I may not be willing to create a new portfolio because of heavy transaction costs that are involved. So all these things need to be taken care of when we are getting into revising and rebalancing norms associated with the new portfolios. These things have to be considered to a greater extent when we get into the portfolio rebalancing process. Now, the various techniques. Now let's come to the various techniques that are available to create portfolios. So typically here we are talking about four major techniques to create efficient portfolios. One is starting off with a screens kind of an approach. Then I will talk a bit about the stratification approach, and then one is the linear programming, which is generally used quite often, and even more sophisticated, which is the quadratic programming approach. Probably linear programming and quadratic programming are two efficient approaches to build portfolios more and more effectively. What I can very well say is stratification is an improvement over the screens approach, whereas quadratic programming is an improvement over the linear programming approach. The simple logic is, in the screens, we are going with selecting all the securities, rank based on alpha. You rank all the securities based on the alpha. So now you are having a top ranked assets, probably top 5, top 10 based on the alpha, and based on them you create a portfolio wherein you will create either an equal weighted or market capitalization weighted kind of a portfolio, a straightforward process, right? So you divide so this is a straightforward process. So or probably a slight improvement that could happen is, okay, the high performing alphas, you can categorize them under the buy category. The very low the alphas which are on the very bottommost layer, you can classify them into the sell category, and in between you can categorize them into the hold category, and based on that execute your transaction. So this is a straightforward approach which is purely based on the raw alphas, sorting of the alphas, and based on that taking your buy sell decisions and creating an appropriate portfolio. But when I look at the stratification approach, it is slightly different. Here, it's same as the screens itself, but probably initially the assets are stratified. Probably here, I would classify the assets, let's say, as small cap, mid cap, and large cap stocks. After that, I will so now in each stratified data, I will apply screens. So for the small cap stocks, I will apply alphas, sort the alphas, buy the ones which are having large alpha, large positive alpha, sell the ones which are having a large negative or the smaller kind of alphas, and I execute the same across the various asset classes. That is a kind of an improvement that is happening to the stratification process over the simple screens. And the third approach, which is the linear programming, is probably the optimization kind of an approach, using the maximize and minimize rules and exposing our variables to various constraints, building a linear programming problem and solving that problem using simplex kind of algorithms, or probably using tools like a solver. So it is primarily looking at constructing a portfolio where the resembling is very close to the benchmark. So using various elements like size, volatility, we try to put various dimensions or various constraints relating to the various aspects of the benchmark, and try to create the weightages that need to be given to the various securities to form the most optimal kind of a portfolio. The same logic goes into a quadratic programming method also, looking at alpha, risk, transaction costs. All these can be incorporated, and a quadratic program can very well be created, and the weights can be decided accordingly. So that linear programming and quadratic programming are the kind of approaches where the various variables, their constraints, their possible values, all are being considered to typically arrive at the composition of the portfolio. And finally, evaluating the returns of the portfolio, when I'm looking at the measuring the returns with what your portfolio model has actually what your portfolio model has created, we are talking about the process of diversification, or sorry, dispersion. Dispersion is a kind of a deviation. Portfolio returns differing from what has actually been predicted, because we are talking about different histories, different cash flows, and different objectives of the various clients. The intention of this entire portfolio management process is try to reduce this dispersion, because for each individual client, whatever the portfolio reporting that has been done, individual clients return, how much is it different from what has been reported, by the portfolio manager. So here, in some cases, it would have been very highly positive. The return would have been much higher than what has been reported, and in some cases, it would have been the other way also. Because for each of the clients, based on their risk and risk taking levels, there could be minor modifications in the composition, though the asset class remains one and the same itself. So even understanding of this dispersion and taking appropriate measures associated with this dispersion is also one of the important activities associated with a typical portfolio construction process. The lessons that come out of the dispersions need to be taken as input for improvisation of the portfolio construction process as well. So that is what I would like to cover as a part of the summary of a portfolio construction process. If you have any further queries regarding the same, you can get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.